There's nothing easy about innovation. It may start with a bright idea, something no one has thought of before, but the hard work is turning your idea into something real. You need to bang a few rocks together, find out which way the wind is blowing, and test your theories to make sure you're putting your plan in the best light.
Welcome, everyone, to Tallahassee Startup Week. I am here and have the pleasure of introducing a great segment tonight. It's Meet the Investors. We're going to have a panel discussion with investors on what it looks like for a company and a founder before they invest. And this is brought to you by Domi Station, part of Tallahassee Startup Week. I'm going to send it over to Robert Blackledge from Domi Station and Bill Nixon. Hello, everyone. How are you doing?
Hello.
Hey.
We're incredibly excited to have everyone here today. You're going to learn a ton of information that I wish I had known when I was starting, and you will too. With that, I will hand it over to Bill Nixon to welcome us all to today's event.
Thanks, Robert. I want to thank you all for participating tonight and thank our guests in advance. Access to capital is critically important at every stage of a business. You all here on the panel tonight represent an incredibly important engine in our entrepreneurial ecosystem. For that, I want to personally thank you for helping to contribute to our economy. After the introductions, Robert and I will ask the panel a few questions, and we would welcome comments and questions for our guests as well. So if you'll drop them into the chat function, we'll get to as many of those as possible. So with that, let's get to introductions. And I'll ask our guests to tell you a little bit about themselves and how they became investors and how they're currently structured as investors. So with that, we'll start with Amy Recht. Amy, thank you for being here.
Oh, my pleasure. Thank you for having me. I became involved with angel investing 5 to 6 years ago, and like many angel investors, made a lot of mistakes at the beginning. There's not really a good how-to book on angel investing that I find is completely practical. So I went down a lot of wrong paths and learned the hard, expensive way. But in recent years, I have joined together with other angel investors, and about a year ago joined in with a group of 6 other investors called Beresford Ventures. And Beresford Ventures has done over the last 3 years 100 deals. We don't do large deals. We never lead. We have some other hard and fast rules, no common stock, only preferred, or notes that convert into preferred. But for the most part, we do early stage, often pre-revenue. And it's just been very exciting, and I've learned so much through being with this group. So.
Thank you very much. Our next panelist is Prashant Mehta. Would you please give an introduction of how you got to where you are and how you're structured as an investor and investor group.
Thank you, Bill. Thank you, Amy. It's great to be here. Good evening, everyone. The way we got started in this is it's just so inspiring to see entrepreneurs, trying to solve problems, individuals trying to solve problems with nothing, with no resources, just an idea and passion. And that kind of attracted us to get involved in early stage startup and angel investing. So we are fairly new. Less than a couple years, we have been doing angel investing. And we, just like Amy mentioned, we focus on very early stage companies where we get to work very closely with the founders and, focus on creating a product market fit and getting them to focus on traction and on the business side. So we focus on small deals initially. And just like Amy mentioned, we have a few rules on where we would invest and where we would not. We are primarily focused on healthcare and related startups, but we are open to other exceptional ideas as well. So it's a pleasure to be here, and thank you for having us here, Bill. Appreciate it.
Well, thank you very much. Matt Johnson is a longtime friend of Domi Station, so we want to thank you for being here tonight, Matt. Tell us a little bit about your story and how you're structured.
Sure. Well, thanks for having me. It's always good to be involved with Domi and your wonderful events and everything that you do for the ecosystem in Tallahassee and North Florida. I've been investing in startups for over a decade. And, in the early years, I did this with just a group of friends and family. We were kind of functioning as a general partnership, just doing one-off deals. Over time, our portfolio grew, our assets under management grew, and eventually in 2015, I said, let me run this full time. Let's convert to more traditional venture fund structured, professionally managed fund. I'll be the general partner, managing partner, and everyone else, becomes the limited partners. So we did that in 2015. Right now, Johnson Venture Partners has 22 active companies in the portfolio. Over that span of time, I've invested in over 30 companies. We've had some successful liquidity events that have set us up to continue doing this. And my goal is to continue to grow JVP and continue to source excellent opportunities. We invest primarily in the Southeast. We're a true seed stage and occasional Series A round investor. So we're kind of filling that critical void in the capital markets here in the Southeast. We're an agnostic fund, meaning we have no industry specialization. We're a generalist, so we'll look at any industry sector and tend to write checks between $50,000 and $500,000 per company.
Well, that's a great introduction, and you all began to answer some of the questions that we have. So with that, you sort of brought up a few topics. One was at what stage do you invest? And I think you all indicated that you have an appetite to some degree for early stage companies. Will you lead or will you follow? Do you invest in pre-revenue companies? And under what circumstances would you take a look at any or all of those things? And as Matt mentioned, if you've got an industry focus, please share that, or a geographic specificity. I know all the folks watching would love to hear these little nuggets. So thanks. And Amy, let's start with you, if you would.
Okay. Beresford Ventures is industry sector completely agnostic. We are also location agnostic. We have investments in South America, Europe, Israel, Canada, lots in Canada. Throughout the US, only not even a handful probably in California, because the valuations tend to be astronomically high compared to everywhere else. What were some of the other questions?
Do you invest in pre-revenue companies, and under what circumstances would you consider doing that?
We do invest in pre-revenue companies. Most of them come out of incubators or accelerators. Our senior managing partner is Jim Horowitz, and he is an active mentor with Endless Frontier Labs out of New York, with Creative Destruction Labs, predominantly out of Toronto. They also, with Quake, so we've seen a lot of their companies from Austin, New York, most recently 5G companies out of Germany, through an incubator that was in conjunction with Deutsche Telekom. We just see companies that span the gamut, but most of them do come from other references, other investors, family offices, and as we mentioned, we don't lead. So we tend to do investments between 25,000 and 150,000. Our average is 50, so it tells you that the majority of our investments are around 25,000. The thought being that once you get at the table, when there are further rounds, which we normally would not, with our check size, be allowed into, we have pro rata rights or we have a seat at the table because of that early investment.
Got it. Makes sense. Prashant, how about you? Under what circumstances would you take a look at early stage companies?
Great. Yeah. So early stage pre-revenue company is definitely one of our focus. What we look for is at that time is the founding team or the founder, and see how passionate they are and how much fuel and energy they can put in to the early stage company, because they're going to come across so many problems, and they have to have the basic energy to take on any kind of problems they face. So that's one big criteria. Second is I really focus on seeing how obsessed they are with engaging with their customer. If they are only obsessed on developing a great product, and then we'll deal with the customer when the product hits the market, that's not something that excites me. You've got to be obsessed about engaging with your customer. Customer acquisition has to be at the forefront. Creating that traction has to be at the forefront. So those are two big areas. And the third thing is, obsession with creating, part of it is creating the product market fit. I tell people have told me, and I repeat this, that, don't smoke your own pot. So we look for that in founders to say, they're not drinking their own Kool-Aid.
Yeah, great advice around the table. Matt, as a managed fund, do you have a different set of criteria when you consider pre-revenue companies?
Well, we generally don't invest in pre-revenue companies, but the way that I define it is as a criteria is measurable traction. So what does that mean? Well, it could mean revenue. You have sales, you have existing customers, and you're generating revenue. Or it could mean that you have a large user base. Maybe you're still not in revenue recognition, but you have a substantial sized user base on your using your product or service. Or it could be that you have extensive market research and survey results, that back up your claims and sort of provide some form of validation. But as a general rule, we won't invest pre-revenue. I like to see some early adopter revenue coming in, and our sweet spot is really when a company is ready to accelerate early sales. So you've gotten those first couple of dominoes to fall in the form of your anchor customers, and you're ready to really aggressively, hit the gas on selling. So that's where we like to invest.
Got it. Thank you. Many investors and groups tend to create their own sort of formulaic checklist or criteria. And in these days, sometimes it's using machine learning and artificial intelligence. So without revealing any secret sauce, do you have some things that you might share with our group that serve as your criteria or checklist that you look at when you evaluate companies for your portfolios? And Amy, if you'll take the lead, that'd be great. And we can switch it up. So thank you.
I'm taking the lead, even though we don't take the lead.
That's right.
Let's see. So what we're looking for in our companies, is that the question?
Yeah. Do you have
Criteria, set rules?
Yes, exactly. Is there are there things that need to fit your specific framework, even though you're technology, geographic agnostic? What are the kinds of things that you look for that make the filter for your consideration set?
We tend to not do consumer physical products. We have one company that does, but that was definitely an exception to the rule. We don't do life science for the most part, because that's not, we'll do medical devices. We even have a CRISPR company, but we don't tend to do drug development. We have one that's out of Jacksonville that, because it was local, one of our members had invested in, and then they had pro rata rights. That's often the way. If we have pro rata rights, we'll bring it to the group if the company is open to that, and we'll follow on through there. Most of the deals have come through the 7 members. They invariably go to the senior manager, Jim Horowitz, before they're presented as an investable opportunity to the rest of the group with that company pitching. And as I mentioned before, we look at the deal docs, and if it's going to be common, we don't do that. Bad experiences with common. We will do priced rounds that are preferred. We'll do notes. But even with those, typically we have some clause in there about it won't convert to common, it will only convert to preferred. Other than that, it's really what is the product, what's the excitement around it, what is the potential. And we have hundreds of companies that make it over the threshold, present to the group, and then when we have our weekly managers meetings, we all discuss each one of those companies. And it's great because everybody has a different expertise that they bring to it and a different perspective, and you can discuss the company and decide, is this something that Beresford wants in their portfolio? So.
Got it. Well, thank you. Thank you so much for that detailed insight. And Matt, I'm going to toss it to you next. In addition to the criteria that you have, you might also speak for those that might be unfamiliar with things like common and preferred and those kinds of mechanisms that you have as investors. Maybe you could touch on that if you would as well.
Sure. Well, I'll reel off a few of our criteria, and then we'll get into some of the specifics around deal structure, equity versus debt versus convertible instruments. But for Johnson Venture Partners, our criteria, initial screening criteria, is pretty straightforward. And this is different for a managed fund than it would be for an individual angel investor. I think it's much more challenging as an individual angel investor, writing checks from your own personal, cash, because it's harder to stick to the rules. With the fund, we have an investment thesis and a mandate that we've subscribed to and our limited partners subscribe to. So I can't really deviate from the rules. So kind of with that as background, we look for companies that are based in the Southeast. That's just our geographic focus. We like to be within a half day's drive. If we need to get somewhere physically, we can. So Southeast based, the team has to be full-time, focused, committed to the venture. If not currently, before this round, then certainly as part of this funding round, to bring them on full-time core management team. And you should want to do that anyway, right? Like, this is your passion, it's your baby, and you should want to be working on it 24/7. So full-time team, scalable product or service addressing a large market opportunity, some form of competitive advantage, whether it be IP or first to market, exclusive contracts, trade secrets, that sort of thing. Repeatable or recurring revenue models. So we like businesses that can, the transactions are highly repeatable, and you can grow very rapidly that way by doing the same thing over and over and over again. Measurable traction, we talked about that earlier in the discussion. Some form of validation doesn't have to necessarily mean revenue, but something that confirms your claims. Seed or early series funding round. So occasional pre-seed, usually we're right there at the seed stage, and then occasionally, a small Series A round. We look for equity, and I think that's a good segue into the second part of your question, Bill, which is, what's all this talk about common versus preferred versus convertible note versus safe? And, as angel investing, private equity, venture capital, entrepreneurship, all of these things have become more mainstream. Investing as an asset class in venture capital, private equity, and angel finance is becoming more of a mainstream asset class. So more people are interested, more participants are coming into the market. What does that mean? Well, the deals get messy. I mean, the structures get wildly different than what was commonplace, 10, 20 years ago. And there's more and more startups coming online, and they want to get funding dollars in the door quicker. So they've come up with these mechanisms to do that without it being so expensive and having to put a valuation on your company. So we'll talk about some of those. Founders usually are issued common stock, right? This is your basic unit of ownership in a corporation, in a corporate structure. So you're not getting the same rights necessarily as, say, preferred stock, which comes with more protections, more rights, and oftentimes more upside potential and less downside risk. There's just different legal agreements that are in place around preferred stock versus common stock. And investors almost always insist on being awarded or given preferred stock in exchange for their high risk early investment in your company. Some other mechanisms to get dollars in the door when you're a startup or early stage business are convertible notes. So this is a debt instrument. I would put the money in the form of a loan, and once you hit some milestone or some benchmark, my debt would convert to shares in your company. So there's a advantage there with not having to create a share price, create apply a valuation to your company. So we get to defer that conversation for a little while at least. I'm going to put the money in now, allows you to get back to running the business. You can start executing on your plan, and I'll hang out earning an interest rate for a year or so until we hit some major milestone, and then I'll convert to equity. Another form of that is a safe agreement. These things originated out of Y Combinator, and it's kind of like a convertible note, convertible debt without the interest. So it's more of a simplified version of a convertible note, convertible promissory note. So those are some of the ways to fund early stage companies. I prefer to do equity. My goal as a fund manager is to own stock, equity shares in a growing, fast growing company. I want to buy stock for $1 today and sell it for 10 or 20, 5 to 7 years from now. That is my goal. So the quicker we can get there, the more efficiently we can get there, and with less, cost is better. So sometimes it makes sense for a seed stage, early stage company to do a convertible note or a safe. I think in most cases, if we just put a little bit of extra work in on the front end of a deal and did priced equity, that would work out for everyone. It'd be better in the long run for everyone. So I encourage you to explore doing a priced equity round first. In some situations, it might make more sense to do a convertible note or a SAFE, but a good attorney, and good advisors, be it investors or, strategic advisors, part of your team can help steer you through this, phase of the business and help you navigate these things.
Thank you so much, Matt. That was great. And and to summarize, the notion of buying low and selling high is always tried and true from an investment perspective. So, and thank you for taking the time to unpack some of the more nuanced investment vehicles.
Well, there's one thing that the preferred stock gets paid back first generally. I think that's one thing I failed to mention that's important for the audience to understand. Preferred shares, preferred owners, tend to get their capital back first, plus some preferential return, whereas the common shareholders do not. So that's the main differentiator, and I failed to mention that earlier. So I wanted to make sure.
No, that's great. And as investors, you want to mitigate risk as much as possible as well. So that's a great comment. Prashant, other filters that you use when considering a potential investment in an early stage company?
Yeah, no, I think Amy and Matt covered most of the criteria. I'll just reiterate some. The addressable market has to be huge. We look for businesses that are going to be massive at scale, and we want to focus on annual recurring revenue, and we look at their plan on how fast they can get to traction. What's their execution? Speed of execution is a big criteria, and that comes from talking to the founding team. Absolutely, they have to be full-time focused on this, and the speed of execution is very critical. We do ask a lot of tough questions, and we've tried to figure out, are they going to just stay focused on doing R&D and just go for developing the perfect product, or are they focusing on getting to the market with a good enough product and beating their competition? The other thing we also focus on is how much of research have they put in, and the focus they have put in on doing some comparative analysis. Do they understand alternates to their offerings or products? Do they understand if there are competitors? We generally are not averse to having competitors in a particular market, but how closely have they studied the competitors is another criteria we definitely look at. So I'll just add those things. And Matt, thanks for the convertible notes and preferred notes. Actually, a lot of founders don't know that, and we spend a lot of time educating them on the mechanics of the deal structure. Sometimes it may be good saying, we can get a price round, direct equity, but then founders want to go look at Y Combinator and try to figure out, safe notes and everything. So we do both. We do safe and we do convertible notes, but we are also looking at some deals as we speak right now for direct equity, even though it is pre-revenue where valuation is extremely difficult, but we are looking at a price round. So thank you, Bill.
No, thank you.
Can I add something to that?
Yes, please. Thank you.
When we were talking about stock, I should clarify that for the most part, and I think Matt's the same, we do not invest in LLCs.
Right.
It can be an LLC with a note that will convert. When they convert in their first priced round, they will convert into a corporation. But we do not invest directly into LLCs. We also require a cap on our notes, a valuation cap. And lately, it's been a post-valuation cap, not a pre-valuation cap. And the reason why is There are some companies out there that will just raise round after round after round of notes. So if you have a valuation cap, say it's $3 million, but they've raised 27 million over years of notes and notes. Really, by the time you convert, that's a $30 million valuation, which is 10 times higher than what you thought you were getting into years before. So most people are now going for a post-valuation cap on their note.
Absolutely. Yeah, I would second that. On both points. So with structure, LLCs are really hard for professional investors to to invest in. We generally are looking for C Corp, Delaware C Corp stock. LLCs are pass-through entities, and so that makes our performance really distorted, and it messes up our reporting and our accounting for a managed fund. And even for an individual angel investor writing personal checks, every time they invest in an LLC, they have to get a K-1 for taxes, and it adds to expense and headache. It's an administrative headache, basically. So, and plus, it's more conducive to raising capital from larger venture firms or private equity, or even going public when you are a C corporation. So that's absolutely correct. On the topic of the notes, again, we don't do uncapped notes, and keep my advice would be, if you're raising on a note, keep everyone on the same terms. Raise a maximum amount of convertible debt and keep everyone on that same note, same terms. Don't get to in a situation where you've got 5 different versions of the note, because it gets very messy when everyone goes to convert, and it can scare away future investors. So keep it consistent for your early investors. Make sure they're getting decent reward in exchange for their risk, and don't do uncapped notes.
Yeah, I second that. We are absolutely focused on valuation cap, and like Amy, we are only focused on post money cap, because otherwise it gets super complicated. We sometimes do LLC. We'll invest in an LLC, but with it'll be written either in the safe or the note that they'll convert to a corporation at the at the conversion event, whichever event that is agreed upon for conversion. At that time, they'll become a C corp.
Not to get us too far in the weeds, but the situation where you would consider investing in an LLC is if there were going to be substantial losses in the early years, and you wanted to take advantage of those losses for tax reasons. Mm-hmm. So that makes more sense for, I think, individual angel investors than it does for professional funds. But if you were, if you are an LLC and you are, say, in the life sciences, or biotech, or some scenario where you're going to experience deep losses for 1, 2, 3, 4 years upon starting up, then there's some tax advantages to being able to pass through those losses to your investors. But for a fund, we can't do that.
These are phenomenal, nuanced comments that are extremely valuable for anybody that's watching the show tonight. So thank you all for that. And there was a brief comment. I'd like to circle back to that. How important are patents and intellectual property or trade secrets in your consideration set? Obviously, with 2 research institutions in town, there's a lot of IP being generated. And as we look at our entrepreneurial ecosystem, unlocking the IP can be a huge economic driver. So how important are those things like IP protection in your considerations?
Do you want me to go first?
Sure.
Yeah. No, extremely important. whether it is patent or just IP, we definitely, that helps them create a moat early on around their business, and we definitely take a look at that. If it's something that cannot be patented, then we focus on how well what kind of plan do they have in protecting their IP or trade secrets and so on and so forth. But absolutely very critical. There's a balance to be kept there, because you could get into patents and creating all sorts of ancillary patents to, protect your patent, and you got to keep it. There are ways to keep it as confidential as possible with the patent office and all those things, and that could become a huge investment, both of time and money. So it's a balance. How much money do you have from your investors? At very early stages, you're not going to have much. So it's a trade-off between going to market and protecting your idea, and how much money you put in, because it's not inexpensive, to get really solid patent application and everything. It takes a lot of time and money. I'll stop there to see what my colleagues have to say.
Thank you. Matt?
I'm probably not the best investor to give advice on this, but IP, in my view, is only valuable to the extent that that you can defend it. I've seen a lot of companies spend way too much of their critical resources, scarce resources, on securing IP around a product or something that never even gets to market. So I like companies that can get to market and start selling and prove their value in the marketplace. Is it nice to have IP protection? Yes. You're not going to lose points with investors for having a patent or several or a really robust IP portfolio. But what did that cost you? And is there any way that you could defend that? Do you have deep enough pockets, and do you have the reserves to actually go and defend that in a court of law, or enforce if there's infringement? So most startups do not have those resources. So I like to focus on companies that are selling, or they are, as Prashant said earlier, they have a healthy obsession with their product or service, and they just want to go sell it. And so again, you're not going to lose points for having IP. And in some cases, like, again, to use the life science and biotech reference, it's critical. But in service-oriented companies, and even in most software and internet companies, I don't know if intellectual property is a must-have in today's environment. Not like back in the day when more core technologies were being invented and being created. I mean, if you've created something that's truly novel and is a core technology that others will build from, then that's important. But I think for the vast majority of startups, IP might not be necessary. Please, any of the attorneys on the call, don't.
Those are great comments. It's if you're going against one of the big technology companies, you need to have a pretty sporty bank account and attorneys on hand. So good counsel. Amy, what's your point of view related to IP and patents?
It depends on what it is. As Matt mentioned, you better be able to defend it. Also, in certain circumstances, when you file a patent, you are telling everyone exactly how this works.
Okay.
So if you are putting it out there for everyone to see and you don't have the resources to defend it, you've just asked for trouble. So in those cases, it's better to keep it as a trade secret. There are certain things like life sciences, health sciences, medical devices, where if you have the IP protected, you are more protected in that case because they have to get FDA approval or NIOSH approval or some type of approval from a regulatory body. So it's much more difficult for a competitor to do that if you already have the IP protected. But in other instances, you don't want to tell them how you do it. So you really have to think about it.
Yeah, and there are ways to have the patent office not publish it, but that costs even more time, more money. So you got to really look at balance. I think going to market quickly and engaging with your customer always trumps having a solid, secure IP that may not be useful. I agree with both of them. I just want to add one thing. We were talking to a company, and they had an IP, a great IP. They had a patent and a great patent. But after doing a lot of comparative research and talking to everything, the value of that was that it's not that they could prevent anyone else from going to the market with the similar product, but if they could protect themselves from not getting sued, or if they got sued, they could defend their product saying, hey, we have created this product which solves the same problem, but it's in our unique way. So you can't come after us. So it all depends on what it is, but going to market always trumps having an IP, in my opinion.
In Tallahassee, we don't have quite as many software and internet-based startups as we do product-based and sort of laboratory-based. I mean, there's a lot of discovery in the sciences. So I think for Tallahassee, it might be important to point out that if you're an inventor or a researcher in a lab, say at FAMU or FSU or TCC, and you're working on this novel discovery or this new creation invention, and your business model, if you're in the private sector, is to license it and make royalties or mailbox money off of that invention, then by all means get the patent. If you're in a lab, at FSU or FAMU, they're going to require that it go through the patent process, and so that the university can earn royalties on that invention as well. So I think, again, in those cases, absolutely get the IP in place. If you're a small and scrappy, software startup or internet-based company, just start selling.
Fantastic feedback. This is wonderful. So thank you. I had an investor once suggest to me. He said, "Bill, as an early stage investor, you got to kiss a lot of frogs to find a prince." With that in mind, where do you go for access to high quality deal flow? I know Amy mentioned some well-known international accelerators and incubators. So I'm interested in where you go to find the good deals or the hot and happening companies.
Well, I'll tackle that one because I'm going to go to Amy, and Amy's going to go to me, and then now we're going to go to Prashant now that we've been introduced. And so it's very much a referral network.
Yes.
Trusted referral network. That is the primary way we source opportunities is through fellow investors, entrepreneurs that we've invested in previously, saying, hey, Matt, you should take a look at this. Places like Domi, incubators, accelerators, sending stuff our way. So 9 out of 10 deals that we do are going to be referral based. And then beyond that, it's pitch events and pitch competitions, technology expos, conferences, research universities that do their showcase events, tech transfer offices, incubators and accelerators like Domi Station, and kind of a wide range of sources, but they're almost always from a trusted referral source.
Yeah, absolutely. Everything we have done so far has been through either a fellow investor referral or the founder referrals. Founders, there was a question, how do we connect to investors? I think entrepreneurs and founders should have their own network of founders of other companies, and they should be talking to each other all the time, and they're going to get you some introductions to good investors.
Great. Amy, anything to add?
There are certain funds that look at companies who have been awarded, and this is getting off in the weeds again, SBIRs and STTRs, especially if they're phase 2.
Mm-hmm.
And so that's another option. If you are good at getting grants, you will get noticed, especially if they're technical grants. And I'm thinking of, off the top of my head, Sensitech, which Ramon was here in Tallahassee, and then he was with Starter Studio, and that was the incubator accelerator out of Orlando. And then the main investor into his round was a company out of Boston, who they're Rhapsody, which they only look at technical companies who have been awarded SBIRs and STTRs. And STTRs is tech transfer from universities, like you were mentioning. So there are other ways that people get noticed.
That's a fantastic comment, particularly because our good friends out at Innovation Park, Michael Tentnowski, does a fantastic job moving companies, training them how to apply for SBIRs and STTRs. So, yeah, obviously getting traction there gives investors unique insight. So, fantastic comment. Thank you. Robert and I talked about a variation on this question, and I apologize for dominating the conversation. What are some of the fatal flaws, third rail or ejector seat kinds of issues that come up either in a business plan or a pitch that immediately get potential companies rejected?
Well, for us, it's not knowing your audience. So, certain angel groups and certainly funds have a set of criteria, and we try to follow that criteria. And if you present something that is wildly outside of those parameters, then it shows that you haven't put the legwork in ahead of time. Because we've done, prior to setting a meeting or engaging with a startup, we've done a substantial amount of homework behind the scenes before we would even engage. So kind of expect the same thing from entrepreneurs. Know who you're pitching, know what their appetite is, know what their parameters for investment are, and what their criteria set is. So that's kind of an obvious one. Other things, the team isn't fully committed. Maybe the founders haven't invested any of their own money. And that's relative, by the way. It doesn't mean that you have to invest hundreds of thousands or millions of dollars if you don't have it. It's just, if you invested $2,000 and that's your entire savings, then that's substantial and that's meaningful. So I like founders that have skin in the game. No skin in the game is going to be a tough one for us to overcome with us. Insanely high valuations, especially given our geography and how things function in our market versus on the West Coast and in the Northeast. So just being aware of that, showstoppers, deal breakers in the form of you're up here and we're down here, and there's no amount of negotiation or education that can fill that gap between what you think your business is worth and what we think it's worth. Other terms in the deal that maybe grant one particular founder or one investor a permanent ownership percentage or equity stake. What are some other things? No board observer rights or board seat. If you're not going to be visible and transparent, then it's probably not going to work or not going to be compatible. So those are some of the things that we look for.
Thanks, Matt. Prashant, Amy?
Oh, we've had a plethora of interesting, and quite a few of them surprisingly have to do with married founders. We had one company that we pitched on that pitched us, that we passed on purely because there were 3 founders, 2 had gotten divorced, the other 2 were getting married. This whole interaction and legal stuff going on. I mean, no. And surprisingly, that's popped up with a couple of other companies, that it's not unusual apparently for, and so we've got a couple of partners who are just adamantly against any married couple founders.
Mm-hmm.
They just don't like it. Others have no problem with it. There have been other cases where it's just, you don't feel like you're getting the whole story, and that there's an expression of somebody is peeing on your head and telling you it's rain. And you can be listening to this and going, that seems really warm rain. Just don't feel comfortable with this. And you can't really put your finger on it, but all of your spidey senses are going off that. And that mainly comes with experience of having been taken advantage of. You learn the hard way, and then you get reticent to have that happen again. So I can't really put it into words or say exactly this behavior will elicit that response, but it's there. So.
Great comment. Prashant?
Yeah, no, skin in the game is extremely important. What kind of time they have put in. If it's not money, it could be, what kind of sacrifices have they made to make this work. And that intangible is sometimes more valuable. So we do look for that. Valuation cap is critical. If someone's going to, if they don't have any traction, they don't have any early adopters, and they want to say, we think we are going to have a valuation cap of, 15 million or 10 million or 20 million, then we know, it's not going to end up well. It's just not going to work out. So their willingness to work with us on a reasonable valuation cap. And third is a board advisory seat or observer seat at least. And they should be open to ideas. If they're just seeking money and not seeking real good advice and true open to learn, if they're not open to learn, then that's definitely a big flag, and we try to run away from that.
Great. Thank you. I know those who are involved in early stage companies may want to do outreach to you. What is a respectful way, if it's appropriate, to contact you or go through an intermediary to discuss the potential, as Matt said, to build a relationship in order to, at some point, get your attention? And as we wrap up with that question, we'll then open it up, and Robert will pass along some questions from the audience. So thank you.
Well, in this connected era where we live online, it's not hard to make contact with someone. But the name of the game is not just getting my email address or phone number or to text or LinkedIn connection. It's did you come from a credible source? So can you get someone to make a warm introduction? Warm introductions go so much further than cold business plan or pitch deck submissions, to my inbox. So get to know someone that knows me, and try to have them facilitate, a warm introduction. It's just like you would introduce a friend, right? Sometimes I think we overcomplicate this part of the process. if you've got something interesting and compelling and you're proud of it and excited to tell others about it, then just go about it in a kind of a common sense way. It's like, well, obviously it's better if I have someone introduce me to Matt or Amy or Prashant. So maybe that's someone at Domi. Maybe it's another entrepreneur that we've backed. We've invested in their startup. It's like, man, I would really like to talk to Matt. Can you hook me up? And that's a much better way to go about it.
Yeah, either of those directions, depending on how much and how resourceful the founders has been in contacting us, that's the first sign of their resilience and their interest. We want to see, are they how hard, or not really hard, but how smart they are going to try to get connected to us or any investors, and that's usually the first sign.
Thank you.
Exactly. And for added context to that, just so you know, today, I have received 13 new inquiries, funding requests today. It takes effort to stand out from the crowd, right? Like you're competing with 13 other entrepreneurs and startups just today to get a captive audience with angels and VCs and investor types. So that, I hope that kind of puts things into perspective for founders. And other like larger venture firms get hundreds of inquiries on a daily, weekly basis. So you've got to get creative, you got to network well, and you've got to find those pathways, to get attention the right way.
Great.
I think being part of incubators and having demo days, is a great way to get past and ahead of the crowd. Definitely warm invitations, because like Matt said, you get an inbox full of people wanting their companies funded. It takes a lot of work also to read through all of those when you have a full plate anyway. So most of the time, there's a whole lot of those that don't even get opened because you just don't have the time. So a warm invite from a group like Domi or from North Florida Innovation Labs, Michael Tetnowski, or some of the others, Groundswell down in Melbourne. John Vecchio is also part of Domi. Starter Studio, and if you can get in one of their programs, investors also know that they have worked with you to organize your company, and that you are a more investable company because of it, and not just coming out of the weeds. So
Fantastic comments, and I will make one quick commercial. Domi has scholarships available now for startups and accelerating companies. So if you see companies out there that could benefit from Domi's incubation support, pass those along. I know we're running short of time. Robert, do you want to pick off a few questions from our audience? This has been incredibly captivating and great, nuanced information that everybody can use. So thanks.
Absolutely, Bill. I've been keeping an eye on them, and we've actually answered most of the questions. But I think a good one to end on, especially with what we were talking about, how to connect with those investors, is this question from Laura Powers, which is, how can you make an impression when you make that first introduction? So they've gotten the call, they're going to set up a meeting with you. What is the best thing they can do to come into that room strong?
Well, energy level matters. Positivity matters. And it's pretty clear early on, upon meeting a founder or a team, if they truly believe in what they're doing and they're proud of what they've built. That is something that's palpable at least to me. And within the first couple of minutes upon meeting, I can kind of sniff that out. So energy level and positivity, sometimes we call this passion, but it's more than that. It's how you carry yourself into the meeting, and then just knowing a little bit of background. Just put some do some homework and put a little time into make it seem that you've learned about Johnson Venture Partners. You've learned about me and my background a little bit. You've learned about our investment criteria and what we look for, and just come in prepared. Preparation. And it doesn't take hours and hours and hours to do that. It just takes a few minutes, and that goes a really, really long way. A positive founder who knows their audience is going to get a favorable response, even if we don't invest. Right? We might not end up investing in your company, but we're going to help you because we like you and we want you to succeed. It might not be a fit for our fund, but I'm going to introduce you to Amy, or I'm going to introduce you to Prashant, or I'm going to send you to Domi or Innovation Park. I'm going to help you, regardless. So all of those things matter. And that one moment could be the difference. Even if, Johnson Venture Partners doesn't become an investor, maybe it's an introduction or a door that I help open that gets you to that breakthrough moment. So it all matters.
Yeah, within it's just like a job interview. You're going to make a decision. You're going to form a first impression, which is going to inform your final decision within the first few minutes. I think authenticity stands out. Be authentic. Know your problem, the problem that you're trying to solve really well. If you're just following a fad and just doing what everyone else is doing, that's really not authentic. Be yourself, be authentic, be positive, be energetic, and that's going to get our attention. Fancy slides and pitch decks are sort of necessary, but that doesn't do much. We use that to just kind of rationalize, the impression we have formed, and then making sure that the founders have done their homework. But it's the first 5 minutes that you have that discussion and how authentic you are. We are looking for, is it really rain or is it someone peeing on your head? So that's the first few minutes. Yeah. Thank you.
And Amy?
I think the other two have really addressed it well. I'm not thinking of anything really to add to that.
And I think the metaphor has been try to avoid causing any rain inside the building.
No warm rain inside, and be coachable. Don't be this is what I'm going to do, period, and I've got it all planned out, and I need your money, but because investors, we have a huge network. So it might not be that we invest, as Matt said, but it might be, there's a company doing something similar over here, and if you guys join forces, or this is complementary to you, there are, or if you go see somebody, go see Michael over here, he can help you write an STTR and SBIR or something. We can point you to resources that can help you move forward until you are ready for investment dollars. Because a lot of times it's just the perception that you got a great idea, but you're not ready for prime time yet. So.
Fantastic point. Well, this has been a phenomenal presentation. I want to thank you all for sharing your insights. It was nuanced and something that everybody could take away tonight, from startups to other folks looking to invest in early stage companies. So on behalf of our members at Domi Station, our great team and board of directors, I want to thank you for attending tonight. And Robert Blackledge and Laura Powers, who are on the presentation as well. If we can do anything for you all as panelists or anyone in the entire ecosystem, please reach out to us. And as mentioned, we have scholarships for startups and accelerating businesses. So if you'll help us pass the word, we'd appreciate that as well. So thank you very much.
Thanks, everyone.
Thank you.
Thank you.